Hi there, Grant Bledsoe from Above the Canopy. Recently I had a client walk into my office who was very concerned about he and his wife's retirement plan. They're both in their late 40s. My client works in private industry where he contributes to a 401k, and his company matches some of that and has a profit sharing plan on top of it. His wife works for the state and will collect a pension after she retires at age 62 in 12 years, according to the plan. Additionally, they have a son who's in college and a daughter not far behind him. And because of that, my client was concerned that, number one, they weren't contributing enough to the nest egg each year to where it would grow to the size they need in order to retire with independence and dignity. Number two, with the college tuition payments coming up, he was skeptical that they'd be able to squeeze anything else out of the budget to increase the contributions if they needed to. So we talked about the retirement plan. And once they retire at age 62, the plan was to withdraw 3.5% of their nest egg each year to supplement their spending needs on top of his wife's pension. And my client was just really concerned that this 3.5% withdrawal rate was too aggressive. He thought that they would extinguish their retirement savings early and have to cut back spending, and that it would increase the likelihood that they lose their independence and dignity throughout at some point in their retirement. So what we did is took a look at the assumptions that go into the 4% spending rule, the 4% rule, which is, I'm sure you've heard of it before. It's the retirement income rule that says that if you have a portfolio of 60% stocks and 40% bonds over a 30-year retirement time span, if you withdraw 4% of your account balance per year indexed for inflation, you'll never run out of money. Well, my client was concerned about his 3.5% withdrawal rate, which of course is less than 4%. And aside from this, the 4% rule has come under some scrutiny by researchers in recent years. So to figure out whether my client's 3.5% withdrawal rate throughout his retirement was going to work or not, first let's determine whether the 4% rule is still applicable today. So this is a review of the 4% rule. It's a review of what's changed in the world since the 4% rule was first published, and a review of current research that retests the 4% rule and tries to apply it to retirement today. So first, let's take a quick look at where the 4% rule came from. A financial planner named William Bengen published a paper called Determining Withdrawal Rates Using Historical Returns in 1994. And his objective in the paper was to find the one withdrawal rate over a 30-year retirement horizon that a retiree could use and never run out of money. So if you take a portfolio of 60% stocks and 40% bonds, how much can you withdraw from the portfolio each year is what he was trying to figure out. And so since he published the paper in 1994, he had historical data all the way up until 1993. And he started back in 1926. So his first 30-year period that he would have tested was from 1926 to 1956. And what he did is checked the performance of a 60% bond, a 60% stock, 40% bond portfolio from 1926 to 1956, and calculated the maximum amount that you could withdraw from that portfolio each year and never run out of money. And then he did the same test from 1927 to 1957. And he went so on, so on, so on until he got all the way up to 1993 and ran out of data to use. So all in all, he had 36 trials where he tested the maximum amount you could withdraw from a portfolio. And what he found is that 4% was that maximum amount. You could withdraw 4% per year from a portfolio regardless of the market conditions and always be okay. Now, Mr. Bengen noted 3 different periods throughout his trials of 1926 to 1993 where there were significant declines in the market that would have really negatively affected a retiree's aspirations to withdraw money from their portfolio. The first was in the early Depression days, the second was in the period directly preceding World War II, and the third was in the recession of 1973 to 1974. And the 4% rule, even for a retiree that chose the very worst year in terms of market conditions to retire, The 4% rule was the one year that worked in every single simulation, even with the worst possible circumstances. So Mr. Bengen's paper was published in 1994, a little more than 20 years ago. What's changed in the world since then? A lot of researchers and some financial planners are saying that the 4% rule doesn't apply anymore. Why is that, and what's different about the world? Well, number one, people are living a little bit longer. There are always advances in medical technology that will increase life expectancy over time and will continue to do so throughout a retiree's golden years. Number two, some economists and researchers think that we've experienced higher market returns in the stock and bond markets over the last 30, 50 years than we will see going forward. And since the last financial crisis in 2009, 2008, 9, and 10, we've entered this period called the new normal, where bond and stock market returns are not going to be as high. Economic growth is going to be a little bit slower all over the globe, and retirees will not be able to see the same returns that previous generations did. Number three, in Mr. Bengen's original paper, he noted 3 different periods of significant market declines, and that was over almost a 70-year period from 1926 to 1993. In the just over 20 years since the paper was written, we've had, it seems like, more than 3 financial crises. Mortgage crisis recently, the dot-com bubble, we had a Russian debt default. We've had 2 or 3 others that I don't know whether they would qualify under Mr. Bengen's definition, but are financial market crises that cause market volatility and pressure in a retirement portfolio seem to be happening a little bit more frequently now than they did when his paper was written. A lot of people think that's going to put pressure on the 4% rule. So now let's take a look at more modern research. And there are a few financial researchers that have been working on this topic over the last couple years. The first one is named Wade Pfau. He's a PhD and professor with the American College, and he published a paper in 2013 with his team of researchers that sought to rerun Mr. Bengen's original experiment, but also to incorporate some of these new normal type theories where we think bond yields might be depressed for a longer period of time, and we might not see the same returns in the stock market that previous generations had. So he ran several simulations. The first was basically to recreate Mr. Bengen's original experiment using the additional history that he and his team had at their disposal. So his paper was written in 2013. He had about 20 extra years of data to use. So what Mr. Pfau found is that the 4% rule would work in 94% of the 30-year retirement intervals from 1926 to 2012. He found a 6% failure rate using the additional history that he had at his disposal. Then he went on to his second test, and he said, well, what if bond yields stay at their low levels that we're seeing now for 5 and 10 years into the future? Because by applying the 4% rule, we're basically assuming that the historical returns we've seen in the stock market and the bond markets are going to persist in the future. So then Mr. Pfau and his team ran a second experiment. And rather than using historical rates like the backward-looking simulations did, they said, well, what if bond yields, instead of using the historical rate, were where they are today? How would the 4% rule hold up over time if we used today's bond yields? And they used the 5-year U.S. Treasury inflation protected securities yield as a proxy for bonds. So they went back and reran all the simulations using historical stock market returns, but also plugging in today's 5-year TIPS yield. And just as an aside, today's 5-year TIPS yield is about 4% lower than it was when Mr. Bengen initially ran his experiment. And what Pfau and his team found is that the failure rate jumps from 6% to 57% by using today's U.S. TIPS yields. For all the retirees that I speak to, my concerned client included, a 57% failure rate is not acceptable when it comes to retirement planning. So based on this experiment, if we think that U.S. TIPS will continue to stay low over the next 30 years, that would imply that the 4% rule indeed does not work. But Mr. Fowl was not content with this. He ran a couple more simulations. Most notably, his third simulation, where he incorporates the view that a lot of financial planners have, where the U.S. tips, yes, they may be low in yield today, but we do expect a rebound and a reversion to near historical rates at some point in the future. So Mr. Fow's third test assumed that U.S. tips go back to historical averages starting 5 years from now. And then in his fourth test, what happens if they start reverting back to historical norms 10 years from now? So in his third test, where he assumed that bond rates start reverting to their long-term norms starting 5 years from the time he published his paper, the 4% rule failed in 18% of the scenarios. When he assumed that they take 10 years to revert back to their long-term norms, they fail in 32% of the simulations. So 18%, still not a high degree, not a very high degree of confidence. 32% failure rate is a little bit higher than most retirees that I work with would like to see. So to summarize, Mr. Fowl thinks that if bond rates stay low over the long term, the 4% rule fails 57% of the time. If they take 10 years to start creeping back to their long-term norms, the 4% rule fails 32% of the time. And if they start creeping back up to long-term norms after 5 years, the 4% rule fails 18% of the time. Now, Michael Kitces was the other researcher to do a lot of work in this area. Kitces publishes his research and his work on his blog, Nerd's Eye View, and he's also a financial planner based on the East Coast. Now, Mr. Fowl's paper was published in the Journal of Financial Planning. And anytime you publish a paper in an academic journal, you subject your paper to the scrutiny of a lot of experts. And if there are any problems with or holes in your research, they tend to come to the surface by going through that process. Mr. Kitces published his work on his blog. And to my knowledge, it hasn't been published in a financial journal. I might be wrong. But that type of work is not subject to the same scrutiny that it would be if it had been published to an academic journal. But what he found was quite a bit different from Mr. Fowl. And Kitces approached the problem the same way Fowl did, and he wanted to recreate Bengen's original experiment using the additional years of history he had at his disposal. But rather than starting at 1926, like Fowl and Bengen both did, he went as far back as 1871. Now, Kitces found that the 4% rule actually works surprisingly well to this day, whereas Fowl's paper was a little bit more negative. And Kitces took a look at how somebody retiring at the worst points in history since Bengen's paper was written were faring today. So he took a look at how somebody retiring in the year 2000, right before the dot-com bubble crashed, was faring in their retirement spending, and how somebody who retired in 2008, right before the mortgage crisis really took its toll, how are they faring? And he found that somebody retiring in 2000 is in just as good a shape as somebody retiring in the three periods that Bengen noted, 1927, 37, and 1973, directly before those recessionary and depression periods that he noted in the original paper. Somebody retiring in 2008 is actually far better off than Bengen's three and somebody retiring in the year 2000. So Kitces is more positive on the 4% rule, and he also points out that 4% withdrawal rate is used as an absolute worst case scenario. So if you had the very worst timing and the worst luck where you retired the day before one of these massive market crashes, that's the rate that's still supposed to work in those periods of crisis. And in 90% of the simulations that Kitces ran, if you withdrew 4% of your portfolio per year, after 30 years, you'd end up with more money than you started with, much less risk drawing your nest egg down to zero. And in 2/3 of the simulations that he ran, retirees ended up with more than double what they started with. So that 4% rule is an absolute worst case scenario. And Kitces says that yes, there could be a financial disaster worse than anything we've ever seen in the past. And yes, people are living a little bit longer. The fact that that 4% rule was aimed to be the very highest confidence, lowest risk withdrawal rate out there, gives him a lot of confidence that it still works to this day. So will the 4% rule work for you? The answer I hear a lot of advisors give is, well, it depends. It depends on your timing and how the markets do and blah, blah, blah. I'm guessing that's not the answer you're looking for. And the conclusion that my client and I came to is that the 4% rule, just to start with, again, is the bare minimum, the most conservative withdrawal rate, where you can be confident that you won't run out of money in the future, even under the worst financial crises and the worst situations that we've had throughout history. And yes, it's possible that we can experience a financial calamity worse than anything we've ever seen before, and it's possible that rates will stay low over a long period of time. But there's one notable difference here that I'd like to point out between a typical retiree's experience and how these simulations were run. And the proxy for bond market returns in all three of the simulations were, they all used 5-year US Treasury inflation protected securities. All the retirees that I work with prefer to build a diversified bond portfolio rather than investing 100% of their allocation in 5-year US TIPS. US TIPS are the lowest yielding and safest securities out there, but there are opportunities to add yield without adding very much risk to a bond portfolio. You can invest in other US government securities. You can invest in investment-grade corporate bonds, preferred stocks, maybe even some high-yield bonds for those with the capacity to tolerate a little bit more risk. In any of those circumstances, it is easy to diversify most of the default risk away and add significant yield to a bond portfolio on top of what you'd otherwise get through 5-year US TIPS. So all in all, I'm very comfortable using the 4% rule, as a matter of fact, because it's so conservative to begin with. Yes, we could experience a financial catastrophe worse than anything we've ever seen before. Yes, rates could still stay low for a long period of time, but it's unrealistic to assume that a retiree will only get the 5-year US TIPS rate over a 30-year retirement. So I hope this was helpful. I'm a fan of the 4% rule. I think it still works to this day. I know that kind of flies in the face of some of the research and some of the popular opinion out there. But if you have any questions or comments or concerns, feel free to comment below or reach out to me directly.